Hello there, finance friends. Welcome to this video. Uh, in this lecture, lecture 8, we're going to cover something that's really important, probably going to be a really big part of your financial future, and that is home purchases and mortgages. So this is a really important topic for a lot of reasons, and we're going to start off this lecture by first kind of talking about why the home decision matters and putting it into context in behavioral terms, in psychological terms, and also in terms of our systems thinking. Because for many of you, your home purchase will be the biggest cash outlay that you make, probably one of the most stressful. And if you do it well, and if you are very thoughtful and deliberate about your home purchase, it will be a wealth building activity. But a few mistakes, some poor planning, buying too much house, getting the wrong mortgage can turn it into a money hole and really, really hurt your finances. So, this is a really important decision, and we're going to talk it through. So the bottom line up here, as you can see, is that buying a home is a major financial decision. A home can help you build equity and build stability, but you must understand affordability, mortgages, and long-term costs if you want to avoid pitfalls like overborrowing and being house poor. This idea, house poor, it's a very important idea. It's a very important term. House poor refers to an individual who has a big home, probably a very expensive and valuable home, and therefore has wealth, but doesn't have cash flow. In an earlier lecture, we talked about cash flow statements, which is the movement of money in and out of your system, and net worth, which is your wealth. Uh, Unfortunately, a common mistake that people make is they buy a house that's far too big for them, that they really have no business buying in terms of affordability. Now, this means that they're going to have a big property, a big home, and possibly over the course of time, as they pay it down, a pretty high net worth. But that net worth is going to come at the expense of cash flow. Because if you buy a house that's too big for you, what we call in personal finance buying too much house, you're going to send so much money out in your payments for that house and just in the upkeep of that house that you're going to starve yourself of other uses of cash, like investing for your retirement, building up an emergency fund, and things of that nature. Okay, so we're going to take this discussion today around four prongs. We're first going to discuss why home ownership matters. We're then going to talk about affordability. Once we understand affordability, we're going to get to mortgages, which is the loan that you'll take out. A mortgage is a loan that you use to buy a home. And it's a really important idea. It's a really great financial tool, but you have to use it well. So we're going to learn about mortgages, and then we're going to use our TVM skills and our time value calculator to do some mortgage practice problems. And those will kind of help us get through the math and make some sense of this. And then finally, we'll talk briefly about points and refinancing, a couple of advanced things in mortgages. So let's talk right now about why the home ownership decision matters so much. And there's a few different reasons. Number one, it's important to understand that just because of the size, because of how expensive real estate is, for many of you, your decision to purchase a home will be the biggest financial decision that you'll make. For most of you, if you buy a home, your home will be the biggest financial outlay that you ever make. So there's a lot of stakes involved in doing it well. Because it's such a big financial decision, it obviously has an impact on our systems lens. We know that you have income that comes in, and we know that we can allocate that income in three broad buckets. We had said that they were obligations, luxuries, and savings and investment. And we had sort of kind of made the rough rule that we were going to make this, 50%, 30%, and 20%. We also said that when it came to this breakdown, your obligations and your luxuries, those were sort of the expenses that you took on for today, and that your savings and investment were expenses that you took on for your future. So you were always straddling a balance between consumption today and consumption in the future, between current you and future you. And if you go by the 50, 30, 20 kind of breakdown, that sort of categorized allocation, you're going to be pretty safe. But imagine you have this big financial decision, and imagine that much more, because you have a big mortgage payment, that much more of your payments, much more of your cash goes to your mortgage and your property taxes. That could spike your obligations far above 50%. And if these obligations go above 50%, you're going to have to cut back somewhere else. And regrettably, unfortunately, what a lot of Americans do is if their obligations get too high, this is the first thing that they cut out. And you can see that's a problem. That's a big potential problem because yes, you're going to have this really big home and have an asset underneath it, but that asset's not liquid. And to pay for that asset, you're potentially starving future use, retirement accounts, and emergency fund savings. So it's a really big decision and it's high stakes. Because it's so big, it's going to be really big throughout our entire system. The housing purchase is so big, it's going to affect all of your systems. It's going to have an impact across all kinds of domains. Obviously, it's going to affect, as we just showed right here, your housing decision is going to affect your cash flow. Once you buy that house and you lock into those mortgage payments and property taxes and upkeep, you are now saying a big part of your cash coming in is going to go out to this asset. So cash flow is really important. Notice that cash flow is also going to be important as you're saving for your down payment. Now, obviously, your house decision will affect your wealth because a house is an asset that generally appreciates, but it's also going to affect potentially your liquidity, the amount of cash that you have to achieve your other goals. You're going to have to insure your house. So your house is going to have an insurance component, and that's going to affect your planning. Because for many people, a house is the biggest, most valuable asset they own, and they want to leave it after they die to children or to someone else. It's going to affect your estate planning. Once you have a house, your decision on estate planning and how you start thinking about the distribution of your assets after you die is going to be affected. Because your house is going to be your largest asset, although not a cash generating asset, it's going to affect your retirement planning. One thing, now there are many good parts about home ownership, but one thing that's really important is you can imagine that if you buy a home when you're, relatively young, maybe in your 30s, late 20s, early 30s, that house is paid off within 30 years. Once your house is paid off, your housing costs sort of fall, as opposed to somebody who's renting, who will have to keep paying rent over time. So it's going to affect your retirement. And it's also going to have a big impact on your tax planning. As we'll discuss in our later lectures on taxes, housing purchases have pretty big impacts on your tax situation, specifically in what we call your Schedule A, which is where you itemize your returns. Some people, if they have a home and they convert it to a rental property, that move to a rental property has some pretty significant tax impacts. And there's also tax impacts when you sell your home. If you sell your home and you sell it for more than you paid for it, that's going to generate what we would call a capital gain. Normally, capital gains are taxed as income. But the US tax code favors home ownership and wants to incentivize home ownership. So there's some really specific rules for homeowners that give you some pretty good tax breaks when you sell your home. So this is going to be all throughout your financial landscape. And for that reason, combining the systems impacts with the big decision, this is going to be for many people a really, really stressful process. So we want to make sure that when you finally do buy a home, you're not walking in cold. You have some knowledge. And that's what this lecture is about. Okay? There's a couple of other aspects about the home decision and why it matters. One of those is the decision of buying as opposed to renting. Now, you can rent your housing, you can buy your housing. They're both acceptable ways to get your shelter. But it's important to understand that, especially in America, where so much of our idea of the American dream is rooted in homeownership, the rent buy decision, although it's economic and kind of financial in nature, it doesn't really end there. This rent versus buy decision goes on to have some very emotional, psychological, and in fact, behavioral components. you know, I would encourage you, pause the video in a bit and just stop and ask yourself, what what messages have you received about home ownership? Do you want to own a home? When you think about this conception of the American dream, when you think about this conception of like adulthood, when you think about these conceptions and these views of, being successful, does homeownership factor into that? And if so, why? And it's natural that it would, because there are so many messages that you're getting throughout your life that, getting a home is part of being an adult and it's part of the American dream. I'm not disputing those messages, but I'm saying that there's a lot of underlying pressure. So this is one of those areas in personal finance where we look at the finance, but there's a lot more than that. There's a lot of behavioral, emotional things, and you want to make sure you keep those clear, that you're understanding what you're thinking, what you're feeling as you go into this decision. The other thing I want to bring up, especially when it comes to rent versus buy, whenever we're talking about a big purchase like a home, I want to encourage you to focus on TCO, what I call TCO. And TCO stands for total cost of ownership. One of the big mistakes that a lot of prospective homeowners make is they think about the mortgage only. They oftentimes get duped into buying a house they can't really afford because the mortgage broker or a well-meaning friend will say something like, with the rent that you're paying right now, for just a couple hundred more, you could have that's a mortgage payment. You should be buying. That's not necessarily the case. When you're thinking about your home purchase, I really want to encourage you to be thinking really, really broadly about the total cost of ownership. In other words, we got to be thinking about affordability. I want to talk about affordability, and I want to talk with you now about the true cost of home ownership. And I would recommend that when you're thinking about home ownership, you break the costs of home ownership into three unique buckets. Okay. And it goes far, far beyond just the mortgage payment. So let's ask the question, what does it really cost to own a home? What are the costs involved? The first category, the first bucket, are what we would call the upfront cash costs. The upfront cash costs are the costs that you have to pay when you buy the home. Okay? There's a couple. The first one is the down payment. The down payment is the amount, the percentage of the home's price that you have to pay in cash. The general rule is 20%. You're generally expected, and it's considered good practice, prudent, wise thinking, to put 20% down. So you take the purchase price of the home, you multiply that by 20%, that's the cash that you have to generate. There's also a category called closing costs. These costs are this big catch-all of costs. Everything from title fees and inspector fees and appraiser fees and insurance fees and document transfer fees. I'll be honest, I think this is a racket. It's basically a way for lots of people to get their hand in your pocket to get a little bit of money, but it's part of the game. These are typically 4% to 6% of the home's price. So that's a lot. You have to have that money up front as a condition of buying. Once you've bought the house, you then enter your second bucket. And this is what we would call your ongoing monthly costs, which we call in real estate finance your PITI. Let's talk about your PITI. Your PITI consists of your principal, your interest, your property taxes, and your insurance. The PITI is the ongoing cost of home ownership. Let's dissect it real quick. When you take out a mortgage, that's a loan for the house, you're making monthly payments. As we learned in an earlier lecture on loans and loan amortization, your principal and interest, that's all wrapped up in your loan payment. So your mortgage payment includes your P and your I, your P, as it were. Okay? So that's your mortgage payment. That's the amount that you're paying on the loan to get the house. But you also have to pay property taxes, and you also have to pay home insurance. And together, those four categories mark what we call your PITI. Okay? These are ongoing costs that you're on the hook for every month. In addition, depending on how you structure your loan, you might have two other potential ongoing costs. One of them, so we'll put a question mark here because you may or may not pay them. One of them is called PMI. PMI stands for private mortgage insurance. To understand this, think back to your down payment. We said that for most of you, you're going to want to put 20% down. That's not an arbitrary number. In fact, the 20% number is the standard because historical analysis has suggested that if you put down 20% or more, your risk of defaulting on your mortgage is very low. So you're considered a safe bet to the bank. But if you put down less than 20%, historically, that leads to a far greater probability of a default on the loan. Banks don't like defaults on loans. Okay, banks want you to pay your loan. So if you put less than 20% down, the bank sees you as a lot riskier. And the bank will force you to buy PMI, which stands for primary mortgage insurance. In other words, if you put less than 20% mortgage down, the bank will take out an insurance policy against your default, and they'll make you pay that every month. So in other words, you're having to insure against the risk of default. And then the other one If you decide, instead of buying a traditional single family residence, a standalone home, you decide, for example, to purchase a condominium and you're part of a bigger unit, you will be on the hook for what are called HOA fees. Those are homeowners association fees, and those are the fees for the upkeep of the property. So we're talking a lot of money here. You've got to put a lot of money down just to get the house. You've got to potentially, you're going to pay PITI for sure, and maybe some other fees. There's a lot of money going out the door, and you're not even done yet, because a house is an organic thing. Houses are complex systems, and they're going to need upkeep. So you're going to have ongoing payments, and this is going to cover expected things like ongoing maintenance and yard care and just expected ongoing, take care of your home stuff. But it's also going to cover unexpected things. You're going to need to replace your roof. That's expected. You can plan that, but you may also have an unexpected water heater blow up, and now you've got flooding. So there's expected and unexpected things that you have to plan for. Most people suspect that these ongoing expenses are going to be 1% of the home's value annually. So now you've got to put money to get the house, money to stay in the house, and money to keep the house going. Those are your true costs of ownership. And we're going to always stress TCO. Okay. One last point on TCO, then we'll run a quick number. Think about this. One big difference between renting and buying. People talk about, building equity, and those are all fine, but I want you to think about something different. If you rent, your monthly rent that you pay, so if you rent an apartment or you rent a home, if you get your housing by renting, the rent payment that you pay is the upper limit. If your rent is $2,500 a month, that and along with your utilities, we'll say, but 25 a month is basically the upper limit that you're going to pay. So if you're a renter, you have a lot of predictability about your cash flow, a lot of control over that cash flow. Now imagine you're a homeowner. If you own, your PITI is the floor. That's the least you're going to pay. So when you're renting, your rent is your maximum, your upper limit. If you're an owner, your PITI, that's your minimum. Between other things, you may be paying far above that. So bear in mind the total cost of ownership. Let's do an example. Say that you buy a $500,000 home. That's the price of the home. You want to put 20% down and 4% closing costs. What are your total upfront costs? Well, your down payment is going to be $500,000, the price of the home, times 20%, that's going to be $100,000. Your closing costs are going to be 4%, so that's going to be the $500,000 times 4%, and that's going to be $20,000. We're going to ignore points right now, but we'll get back to that later. So even if you don't buy points, you're looking to have to kick in $120,000 on the day that you sign the document to formally buy the home. So you better be thinking, that's a lot of money. Where are you going to get that money? Do you have a savings plan? If you say to yourself, okay, I want to buy this house in 5 years, I'm going to need $120,000, you're going to need to apply some time value tools to take where you are right now, to take how much money you want to have in the future, and to get there. A lot of planning. And as you're saving to get this total upfront money, there's opportunity cost, right? Every dollar that you set aside for your future down payment and closing cost fund, for your dream house fund, every dollar you set aside is a dollar you no longer have to fulfill obligations or luxuries in the present. So once again, current you is going to have to find a balance with future you. Okay, so that's how we would run that upfront number. Let's go to example number 2. Let's say that you finance the house with a 6% 30-year mortgage. Now, we'll figure out how to calculate mortgages later. I'll teach you how. But for now, you're going to finance the home. What does finance mean? It means you're going to borrow money. Since you put 20% down on the house, you're going to finance the house with a loan, with a mortgage equal to 80% of the house value. So $500,000 house times 80% is $400,000. That's the amount of loan that you're going to have to take out to buy this house. Okay? Your principal plus your interest, I'll teach you the math later, but for now, trust me, is going to be $2,398 per month. That's the P and the I of your pity. That's your PID. Let's assume that property taxes are 1% of your value. So if your house is $500,000 of value at 1% property tax, that's $5,000 a year. Divide that by 12, and that's going to be property tax of $417 per month. Let's assume that you have to have homeowners insurance and you pay $300 a month. And then, just to make this really simple, let's ignore HOAs and PMIs. Let's say that you put down the 20% so you don't need PMI, and you have a home, a standalone single family home, so you're not taking out HOA, you're not paying HOA. Well, you add all this together, and now you're paying at minimum $3,115 a month. That's your pity. Now think about what this implies. You're going to be sending out 3,115 per month every month for 30 years, which is the standard loan term. Think about the opportunity cost involved, especially when you first buy the house and your income is relatively low. This is a big sacrifice. I'm not saying don't do it, but be aware of the opportunity cost, because every dollar that you're paying toward that pity is a dollar that you don't have for current you to spend, or for you to invest in future you something else like stock market or retirement planning. Okay. Always trade-offs. We're not saying it's good or bad. We're stressing the tools of awareness and of clarity. Try to build intuition on flows of money and the sacrifice that it entails. Okay? And now, one more thing. If your house is $500,000 and we're going to budget, let's say 1 to 2% for upkeep, you're also, in addition to your pity of $3,115 a month, you're also looking to have to somehow set aside anywhere from $5,000 to $10,000 for your upkeep and your maintenance. Okay, so this is a really big thing. A lot of people don't understand all of these rules and all these calculations, so they walk into the house purchase a little bit blind and they buy too much house. I want to ask you what it means to buy too much house. What do you think that means? Well, too much house basically means that you're putting so much money into your pity and into your upkeep that you don't have money left for other purposes. In other words, You can be house rich. You can have a wealthy, wealthy house, but you can be cash poor. If you're dropping a big percentage of your income to your house, you've got a problem. Okay. This is also known as being house poor. House poor, again, a situation where you've got a home, but that home sucks so much cash from your flow systems that you have no other money available for things like saving for retirement, saving for a children's college fund, taking a vacation, other things. Okay. So we want to be really attentive and try to avoid being house poor. And to do that, I want to introduce you to two rules. We call these rules affordability ratios. And the affordability ratios also go by what we call the 2836 rule. This comes down to two measurements. One of these measurements is what we call the front end ratio. The front end ratio says that your pity must be less than or equal to 28% of your gross monthly income. That's your front end ratio. That's the 28 in the 2836 rule. The other ratio is what we call the back end ratio. And the back end ratio says that your pity plus all your other debt payments, your pity plus all your other debt payments, car payments, credit card minimum payments, student loan payments, that all of those together must be less than or equal to 36% of your gross monthly income. You can see from the back end ratio the potential perils of debt, as we've discussed before. The more debt you have, the more other cash you have going out, it could affect your back end ratio. So these two rules, the 2836 rule, the front end ratio and the back end ratio, are designed to help you afford buying too much house. Let's see how it works with two more examples. Now, we said earlier that our pity was $31.15 a month. So let's just remind ourselves. And let's look at example 4. What income do you need to comfortably afford this house, assuming you have no other debt? Well, let's do our front end. Says that your pity must be less than or equal to 28% times your gross income, monthly income. This means that 3115 should be less than or equal than 0.28 times your income. Do a little handy dandy algebra. And therefore, 3115 divided by 0.28, that has to be less than or equal to your income. And when you work the numbers out, this comes to 11,125 per month, or an annual income of 133,500. This is the annual income that you need to comfortably afford a front end ratio of 28% if your pity is 3115. Okay, let's do a back end ratio question. Now, in addition to your pity, which we said was 3115, now you have a student loan payment. And because you were maybe a little bit of a jabroni, maybe you took out a car loan that maybe you shouldn't have, you're sitting on a $600 monthly car loan payment. Let's do the back end ratio. Well, the back end says that your pity plus all your other debt payments must be less than or equal to 36% times your gross monthly income. Well, that means that 3115 plus 950, because 600 and 350 is 950, must be less than or equal to the 0.36 multiplied by your income. This means that 4065 must be less than or equal to 0.36 times your income. Little handy dandy algebra. 4065 divided by 0.36. And this implies, therefore, that you need an income of 11,292 per month, multiplying that by 12 of $135,500 per year to afford this house. Note that these are the same ratios that a bank would apply to you. If you were to go to a bank and they calculated your front end here and your back end here, they would insist that you have the higher income. So for a bank to approve this mortgage for you, you would have to have an annual income of $135,500. Okay? So that, my friends, is the opening. We know the big picture of mortgages. We know the systems lens. And now we have, I hope, a much deeper sense of the total cost of ownership and of the importance of handling your cash flow and balancing your home purchase with your other goals. Okay? We're going to end this video now. And in our next one, we'll learn about mortgages, how they work, and I'll teach you a little bit of mortgage math to help you kind of do some future problem solving yourself, including a few tools that you can use to pay off your mortgage early, which is a good idea if you can swing it, okay? Thanks for your time. Have a great day, and I'll see you in our next video.